All right, folks, we're going to go ahead and get started today. As always, thanks for joining us. And we have this month Michael Montemayor with Russell Investments coming in to be a part of this month's market update webinar. Michael, as always, man, really appreciate you taking time. And kind of just, again, I always say pulling the veil back, right? Trying to help our clients cut through the static and the noise and try to figure out how to make sense of why the headlines say this, but why everything else seems to be very different from a data standpoint anyways. So appreciate you as always.
Happy to be here. Thank you, Mark. And I always claim that I don't probably know anything more than you do or anyone else on this call, but I try to help as much as I can.
Oh, man. I don't know. You're very humble. add that to the list.
Thank you.
Anyways, but no, man, as always, let's just kind of start with kind of a recap of one, what's been driving markets so far this year, right? So kind of recap why markets have been so robust to start the year.
No, that's a great question and a perfect place to start. And we'll kind of hop back and forth on some of these slides that I have to kind of help complement what we're talking about. But, you know, first of all, where I'll kind of start is actually looking at this slide right here. Because when you kind of think of where we got to where we are today, you know, end of July, stock market's up almost 20%. How have we got here? The easiest way to answer that is really looking at this chart right here and showing that, you know, you look at the S&P 500 index being up, again, this is a little bit dated already, you know, it was saying 17% on this, but it was actually up closer to, you know, almost 20% so far this year. But you look at that leadership and where these returns are coming from. And really what we're showing you on this chart is if you look at the S&P 500 index, the top 10 company weights and share of the return. So you look at the top 10 weight in the index, the top 10 stocks in the S&P 500 right now make up 32% of that index. 73% of the return that we've seen so far through the end of June has come from these 10 stocks. And you could even boil it down a little bit further and look at just the top 7 stocks. You know, if you look at your Apples and your Microsoft and Alphabet and Nvidia and Tesla and Meta, you know, that is driving a lot of these returns that we're seeing. And a lot of this is, you know, based on the news. I know if you turn on Bloomberg right now, if you turn on Fox Business, if you turn on CNBC, wherever you get your news, they're talking about the Magnificent Seven, but they're also talking a lot about AI, you know, artificial intelligence, you know, with ChatGPT coming out. And, you know, we're starting to see kind of this craze into the AI space, which it's exciting times, you know, just like when the internet came out, it was pretty revolutionary and changed the way that we live. We think AI is going to have that type of impact as well, but a lot of these names are being bought because these are the leaders in AI. So, you know, long story short, AI and these 7 stocks, you know, are really driving this robust market that we've seen so far. But it's not just the AI craze. You know, if I kind of take a step back here and go back to this chart over here, this is just looking at economic indicators and as well as, you know, our market indicators. And yes, there's kind of this AI craze going on. A lot of people kind of diving into those, you know, mega cap stock names that are driving a lot of the market. But there's also a lot of things in the market that are becoming more certain and taking some of the uncertainty out of the picture. And I won't go through everything on this screen here. But when you look at last year, 2022, obviously extremely difficult year because there was a lot of uncertainty about how bad inflation was going to be, how much was the Fed going to raise rates, which we have another meeting with the Fed coming out today about what interest rates are going to do. And, you know, 99%, we're going to see 99% chance, or the market's pricing in that we see another rate hike. But obviously those were concerns that we didn't know what that was going to cause for the markets. Now, the thing is, there was a lot of market volatility measured by the VIX index last year. And the VIX index is actually just the index gauge of market fear. So whenever we see a lot of selling, a lot of moving around in the market, the VIX index goes up. When we see a lot of less selling, more buying, the VIX index goes down. And VIX index has continued to go down. So that really is pointing out that, you know, a lot of investors out there are getting less skittish about the uncertainty that we saw this year. So you kind of have this picture that's a little bit brighter because we kind of know where we're headed versus last year where we didn't know where we were headed. Now that market volatility coming down is a plus because that tends to be a positive for US equities. And that's what we've seen so far this year. Now, the other aspect of it though, too, is I'll stop there on the 10-year US Treasury yield. Now, last year, again, we saw the fixed income market sell off, kind of one of the worst years that we have seen in, over 30 some years in the fixed income side of markets because of the Fed raising interest rates. Now, the Fed's raising interest rates to fight inflation. We know all of that. And but the thing is, and the reason why I wanted to stop on the 10-year US Treasury is also how have we got here to where we are today is your fixed income is actually paying a coupon. It's actually paying a yield these days. So that really helps when it comes to a lot of clients that are invested. I know we're not all invested 100% US equities. So you think about that fixed income portion of your portfolio, unlike last year where it was a big detractor, it's been adding to the portfolio because now you have coupons being paid, fixed incomes paying interest finally, and that really helps the overall total return story. So with 10-year US Treasury yield coming up, that's helping our portfolios as well. Now, a couple other things that I'll talk about with the picture kind of clearing up with the US economy. I know there's a lot of uncertainty around what's going to happen next year with recession outlook and all that, and we'll address that here in a little bit, of course. But I also kind of like pointing out, if you look at inflation, that was one of our biggest concerns last year. Inflation has come down a very good amount. And we have another chart that we can show and look at this a little bit later. But inflation, the CPI rating just came in at 3% last week. 3% for CPI. When you look at core CPI, it was about 4.8. So that's when you kind of, strip the housing and gasoline prices and all that stuff. But inflation is coming down, and that's the direction that we want to see. And with the overall investor base out there seeing inflation breaking and what the Fed's been doing has been kind of helping, that also takes some of that uncertainty off the table. Now, when it comes to unemployment, this is one thing that I've been kind of talking through a lot too, is because, there's a lot of uncertainty about where the market's going, of course. But also why I think we've seen such robust markets so far this year is unemployment has sort of within the last 3 unemployment readings have gone from 3.5 to 3.7 down to 3.6% of the working, the people that are eligible to work. So unemployment is still close to all-time lows. So what does that mean? People have jobs. If people have jobs, they can go out there and spend, they can buy flights, they can go out to dinner, they can, purchase things. And we're seeing that being a big driver of this economy that, the consumer really hasn't slowed down. So there's positives there. A retail sales report just came out last week. Retail sales have been coming down a little bit month over month. But when you strip out the price, the sale of cars and gasoline from that retail sales report, it grew by 0.6% versus 0.3 expectations, which I know that's getting down to the nitty gritty. But at the end of the day, people are spending. And when you have people that have jobs and they're spending money, that means that our economy is going to do pretty good. And one analogy I always like using, and Mark, you've probably heard me say this before, but think of the last time you got sick. The last time you got sick, you probably thought it was going to last a lot longer than it did, that you thought your symptoms were going to be a lot worse than they ended up being. That's kind of what a lot of people are thinking about the US economy right now. There's a lot of symptoms that are being shown that our economy is slowing down, but we also forget that the US economy has one of the best immune systems in the world, just like all of us do. And that's why our sickness didn't last as long or wasn't as bad as we thought. 70% of the US economy is driven by the consumer. And when you think of how strong the consumer is right now, if we even see, potential recession next year, mid-year to late next year, we do think it's going to be very shallow, very slight, and we're going to get that soft landing as we're kind of seeing. So, there's a lot of noise out there when you turn on the news, but I think when you actually just kind of take a step back and look at these economic indicators and what these, market indicators are telling us, it's telling a better story than what we're hearing on the TV and the radio a lot more. I think we're in a really good position. Now that could change because we are starting to see things slow down, which we'll address in a little bit. But I think that's kind of where we got to where we are today. So I'll turn it back to you if you have another question or want to add any comments for us.
Man, I think just a quick recap. Again, I could process this pretty just bam, 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 because I'm in it every day. But if I just kind of quickly summarize, right? So markets have driven substantially higher this year, right? Mainly because of those top 7, right? Tech companies, the AI craze, et cetera. You never know that we had any banking issues 3-4 months ago. By the way, anyways, so besides the point. But also investors, and when I say investors, Wall Street is really embracing the idea that inflation's coming down, which was kind of the key issue that they wanted to see. And to your point, the CPI, I always say that that's our definition of inflation because it includes food and energy, down to 3%, right? As you said, and the core inflation, which is what the Fed really cares about, still at 4.8. It's coming down, just not down as fast as the Fed wants it to. And anyways, so I think the other points that you hit on were that, one, volatility and consumer, but investor sentiment have improved. And so that's aided to the market rallying as well. And then the last thing on data points, with inflation down, consumer spending, which again, just reminder for all of our clients, that's about 2/3 of our economy, right? Is consumer spending. That's why that metric is such an important metric when you're talking about outlooks, is that if consumers can keep spending, whether that's unemployment or jobs added, whatever, then that helps drive our economy forward. But 3 point whatever, that's pretty darn good for as far as unemployment goes. And on the consumer spending side, I'm glad that you got down in the weeds on that to point out that really, I mean, retail sales are still continuing to grow faster than expected when you strip out vehicles and some of the other categories. So it kind of almost answers like 2 questions in one then, Michael. What's driven markets so far year to date, and where are we now, right? Mm-hmm. So any other thoughts as far as like where we are now as far as the economy, markets, et cetera?
Yeah, definitely. And thanks for the recap on that. And we definitely have some good slides here that will kind of address where we are now. And I think to kind of start that question, I like just to kind of show this slide here, because where we are now is really looking at, these different asset classes when it comes to this is more so the market, and we'll address the economy side of things as well. But when you look at where we are now, we're looking at these major asset classes, anywhere from US equity to emerging markets to, international stocks and, your real estate and commodities and all that good stuff too. So these are a lot of asset classes that I'm sure, including me and everyone else on this call, have some type of exposure to in their portfolio. And really what I like looking at is, you look at Q2, and I don't like to focus on the short term as much, because at the end of the day, we all have long-term investment goals, and we're more so focused on the next 10 years and 15 and 20 years. But where we are now and kind of is looking at, just over the last quarter, we've seen US equity have a really good run. And again, that goes back to the AI craze and, really seeing, a lot of this uncertainty, kind of move out of the limelight a little bit. One thing that I think is kind of surprising though, too, is where we are now is if you look over just the last year, look at US equity, it's up 19%, but also look at international equities being up almost 18.8%. So, not only are we seeing a really good run in the US equity side of things, we're also seeing a really good run on the international equity side of things. And I think with all that narrow leadership that we've seen in the US stock market, that's nice to see that we're getting some diversification, some type of returns from other parts of the portfolio. So again, we're kind of seeing good market rallies and recoveries from the 2022 lows across the board, not just within the US, but internationally as well. So for everyone that has international exposure, of course, that's a good thing. Also, maybe something to maybe think about adding to your portfolio if you don't have too much exposure. So that's just one thing to think about. One other thing that I'll leave everyone on here on this chart is think about everything that we've been through over the last 3 years. You've had a pandemic, you've had Russia invade Ukraine, so there's a war going on. We've had a good amount of volatility in the market. We have the Fed raising, rates at unprecedented, rates, and inflation, on a tear, which is obviously coming down now. So we've all been through a lot. But I think when you think about all these things that we've been through, And again, where we are now is look at those 3-year, 5-year, and 10-year numbers. When you look at all these asset classes, especially over the 3, 5, and 10-year, you're almost a positive across the board for your portfolios, despite of all the things that we've gone through. So I just think it's a good reminder for all of us that stuck with the plan, stayed invested. We've fared pretty well when it comes to what markets have done. So another way to kind of look at where we are now. Another thing that I wanted to kind of add though too is when it comes to that narrow leadership that we were just looking at, here's another thing that I think kind of addresses where we are now and where we might be going. On the US equity side of things, now this is a very unique occurrence that we've seen kind of play out only 16 times before. If we look at the S&P 500 index going back to 1953, and what you'll see here is the S&P 500 actually just hit new 52-week highs on June 12th of 2023. So this just occurred last month, not too long ago. But what was unique about this occurrence is over hitting that 52-week high, we had actually gone more than a year without hitting a new 52-week high. A lot of volatility there, a lot of moving sideways in the markets, kind of what we saw. So we didn't see that 52-week high hit as frequently as it typically does. This has actually only happened 16 times before where the US stock market hits that 52-week high after going more than a year without one. So we wanted to kind of look at what does that mean for the overall index. What does that mean for the outlook? The first thing I like drawing everyone's attention to is look at what the S&P 500 has done since 1953 to 2023. It's gone straight up. Obviously there's a lot of bouts of volatility, but when you look at the longer time frame, that market's going up, even with those little bit of corrections that we've seen in the past. So right there, I think we all need to keep a more so longer time frame mindset. But now when we look at these 16 occurrences when this has occurred, that 52-week high after going more than a year without one, what has the market gone on to do over the next 1 month, 3 months, 6 months, and 12 months? And again, this is kind of why I started with my comments earlier that I don't know any more than anyone else on this call. I don't know what the market's going to do over the next 1, 3, 6, or 12 months, but we have to use history to kind of give us an idea of what we might see. And I think this chart kind of helps because when you look at what the stock market has done the 12 months following this occurrence, again, that 52-week high, so markets hitting a good return after going a year without hitting one, 100% of the time, the market posts a positive return following those 16 occurrences over the next 1 year. So right there, I know we can't say that's going to exactly play out again this next 12 months from the beginning of that date of June 12th of 2023. But looking at history, it really gives us a little bit of positive outlook of where the market could be headed. And then you also think about the range of returns that we've seen. It's been anywhere from 3.1 up to 42.1%, but that average return, the following 12 months, the last 16 times this has occurred, it's been about 17.6% of the of return. So again, kind of where we are, where we're going, I think, this is kind of something to look at, is where the S&P 500 might still have some really good momentum. And just one other stat that I'd like to drop is, historically, if you look at the S&P 500 and it's up more than 10% through June, it continues to move higher in that second half of the year historically. So I just think that for a lot of investors out there, when you think about Wall Street, some people have been talking about taking some gains off the table because of this run that we've seen in the S&P 500. Well, a lot of people are quick to neglect the momentum factor in markets. And there's a lot of momentum potentially in US markets, especially as we start to see that narrow leadership start to widen, evident by kind of what we've seen the Dow index do over the last 13 trading days as well. So again, a little bit there. I'll continue a little bit, Mark, because I did want to include this chart as well. On the international side of things, of kind of where we are today, I also think, we sort of mentioned this, international has had a really good run over the last 12 months as well. And I think this might continue as well. I think international is going to continue to help in our portfolios And really what we're looking at here is this chart is looking at the US dollar index going back to 1971. And just like the market goes through cycles, and just like, the Fed funds rate goes through cycles and everything goes up and down, so does the US dollar index. And that's really what we're seeing here is when you look at this chart, we're looking at the US dollar sort of depreciate, then appreciate, then depreciate, then appreciate, kind of goes up and down. The thing that I think stands out to me a lot on where some opportunity might be going forward is look at every time the US dollar is depreciating, and that's evident by the blue. And when you look at those time periods below the line graph there, whenever you have a blue time period, the S&P 500 doesn't mean the S&P 500 is going to be negative. It just tends to be the loser of the bunch that we're looking at here. And you actually tend to see international securities and markets do pretty well. So when you look at, all those time periods, Japan, Europe, emerging markets or Europe tend to lead the show. And we're actually getting to one of those periods right now where we're starting to see the US dollar depreciate. Now, I don't want to scare anyone, and that's not a currency, threat. We don't think that's going to be a huge issue that the US dollar depreciating. We think it's just another part of the cycle that we're seeing there. But that is going to be a tailwind for international securities. So again, with the stock market having narrow leadership so far this year, if we don't see that sort of leadership continue to widen, some opportunities might be just making sure that we have some international aspect in there in the portfolio, because we do tend to see that be an opportunity when that US dollar is depreciating. So I know I covered a lot there, Mark. I'll stop and let you recap me, because you do a really good job at that.
Man, there's a lot to recap, but if I kind of just succinctly put it, maybe the best way is that where we are now, markets are essentially at a new 52-week all-time high, right? We eclipsed that level sometime back in June. Statistically, when we look at those time periods, the market is up over the next 12 months, 100% of the time. And that up is a range of 3.1% to as high as 42%, but the average has been about 17.6, right, over the next 12 months. I'd also venture a guess, Michael, that on this point, right, whenever the market doesn't hit a 52-week high, right, for a year, it's because earnings are generally declining. And so as it starts to pick back up, the anticipation of earnings turning around starts to come into the picture. And by the time that the earnings start coming in, Wall Street's already expected it, if you will. And so the earnings keep growing in behind the expectations. Anyway, so side note is to try to explain why that happens normally. It's not just like a fluke occurrence, but if you look at what, again, drives markets long-term, it's earnings and how much people want to pay for those earnings. And so again, nobody has a crystal ball for the future, but statistics are hard to argue with in this case. And then you'd mentioned a couple other things as far as where we are now. The dollar devaluing relative to other currencies. It's a cyclical process that we've seen play out over the past many decades. I think there's probably higher anxiety right now amongst our clients because of the threat of the dethroning of the dollar, right? And there's been some news media headlines about that. But separate issue that maybe we can come back, Michael, and talk about later on in closing. But when what I heard you say is that anytime the dollar has been depreciating, then generally it favors international stocks historically during these cycles, and we start to see international stocks outperform the U.S. stocks. Did I get it right?
Yes. Yep. Exactly. And vice versa. When the U.S. dollar is appreciating, that tends to be really good for U.S. stocks. And we see that kind of goes through cycles. So the whole idea of, owning a little bit of everything, making sure that we have those equal proper weightings so that we can take advantage of both of those occurrences. And right now we think it's going to be kind of an international opportunity to help there.
For sure. Well, then I guess, and you hit on this a little bit, but as far as the let's say balance of the year and into next year, right? So far, I've heard you mention a couple different things. One, potential recession, right? Two, what we just looked at on forward returns whenever the markets have been in this exact same position before, right? So potential recession, optimistic outlook as far as equity returns, potential for international to continue the pace that they've been on, right? If the dollar keeps coming down. I mean, any other comments about kind of like the balance of the year or what we should be expecting to play out as far as just like data points or what Wall Street's thinking?
Yeah, no, that's a great question too. And I put the Russell Investments Global Market Outlook on the screen, and I'm not going to read this back to everyone, of course, but I do want to point out a few things. And just so everyone on the call knows, Russell Investments, we've been around since 1936, but we really kind of found our start to who we are today back in the 60s, where we actually pioneered pension fund consulting and money manager research. The reason why I wanted to kind of fill everyone in that is Russell Investments, our approach is we know we can't be the best at everything. So what we do is we go out there and try to find who's the best at global equities, who's the best at picking stocks, and who's the best at picking fixed income returns. So we actually leverage and outsource a lot of our portfolio management to some of these best and brightest names out there. But the reason why I brought that up is we actually send out a survey to all of these portfolio managers that we work with each quarter. And we ask them, what is your expectation for global equities? What's your expectation for fixed income? We ask the equity people the equity questions. We ask the fixed income people the fixed income questions, of course, and get their takes on it so that we can kind of get this best ideas of what the overall market and some of the smartest investors are thinking. And the nice thing about it is we put everything that we found on those surveys and put it on this one page as succinctly and as little as we can, so that you can kind of look at that. So really what we are kind of thinking about of where we are potentially headed is Russell Investments is in the camp, and majority of these portfolio managers that we've surveyed are in the camp that we probably see some type of recession mid-year to late year next year. And a lot of that, and what I'll kind of, before I even, go on to more things on this page, I'm going to skip to this one. A lot of that is because although, Mark and I have kind of talked about, and more so I have talked about, things are clear, a little bit clearer, unemployment's low, people are spending, there's a lot of good things. There's also a lot of things that are slowly slowing down. So, although we think we're in a really good position right now and probably through the end of the year, we're starting to see a lot of these economic indicators sort of point out that things are slowing down. And then a few things I'll call out here, and this is us really getting into the weeds and looking at all these different, economic indicators, which again, I'm not going to address all this, but some things that stand out to me is the fixed income guys are often said that they're the smartest in the room. They just, they're unique people. But whenever the yield curve inverts, we tend to see a recession follow from 12 to 18 months. And they really have not been wrong on that. Where you see that yield curve inversion, you tend to see some type of recession play out. Now, could that have been the technical recession that we saw last year play out? Could that be something that's still coming down the road? It's something that we don't know, but we are keeping our eyes on, and you see that we've sort of moved that from orange from last year up until red this year, because that's definitely a concern. You also think about when you look at the yield curve, like we were kind of mentioning, that's also in the red. But also when you look at ISM manufacturing and ISM non-manufacturing, I like bringing this up because I'm sure a lot of people have heard this term of rolling recession. That we've seen sort of the housing market go through a recession and they're starting to kind of recover. We've seen the manufacturing, sectors sort of go through a recession, and they're still in recessionary levels where their readings and their outputs below 50. And whenever it's below 50, that means that it's technically not growing. It's actually declining. So a few things that we sort of point out is, that is continuing to slow down a little bit. So all of these things that are potentially were green or yellow last year are now orange or red this year. So again, we've sort of seen things slow down, and that's why we still think there might be a recession mid-year to late next year. But my comments don't change on, and the same to the comment that you made, Mark, where 2/3 of this economy is driven by the consumer. And when you look at all of the green boxes on this page, and again, I know there's a lot going on here, but you look at household debt services, you look at household debt levels, you look at bank loan demand, you look at, again, unemployment, all of those things are still in the green. And I think when our consumers are in a good position, that's only a positive for the overall outlook of the economy. And that's why, again, we see a lot of things slowing down, but we think the things that are most important are still in the positives and still in the green. Now that could change, and that's why we have these calls on a quarterly basis. But right now, it seems like we're in the green. And again, that's kind of where we go back to this page. And I would just say, we probably see that recession mid to late next year. Now, when you look at the Eurozone side of things, I'll kind of paint a little bit of a picture there. We still see some opportunity in the Eurozone equity markets and the stock markets. And as many people on this call know, that when the economy is doing good doesn't mean that the stock market's going to do good. And when the stock market's doing good doesn't necessarily mean the economy is necessarily doing good. And, the Eurozone, although we have a good outlook for the Eurozone over the next 1, 3, 5 years, the outlook there is turning a little bit more negative. We just saw the UK inflation finally spike. It might have finally spiked. That just happened. So one thing I would just say there is they're a little bit behind the curve ball when it comes to the inflation side of things. Inflation is still running there. That's still going to have an impact on the economy. We potentially see a recession there sooner than what the US is. But again, doesn't necessarily mean that we're going to see negative returns on the stock market, because there's going to be other things that are pushing that way. Like I mentioned, when we kind of talked about inflation, inflation has peaked in most regions. We're seeing it come down within the US, and I think that's going to be a positive for the Fed to start to slow down the rate hikes. We probably do see that 25 basis points, today. And then we have to also look at what type of impact that's going to have on the economy over the next 12 to 18 months, because a lot of that does have a lagging effect. But now that we know inflation's coming down, we know that we're not going to see at least another 500 basis points of rate hikes. And if we do, we got bigger problems than we're facing now. But again, I think that's positive. And as I mentioned on the fixed income side of things too, sorry to kind of jump around, but the fixed income side of things, it's an attractive outlook for fixed income, because when you have interest rates where they are today, and they are finally paying a coupon or yielding you some interest on your fixed income, well, that helps to the overall total return situation, because now you're getting income from there. And the Fed, after they do that last rate hike, typically after the last rate hike of every cycle that we've seen going back to the 90s, and we'll touch on this a little bit, I'll actually jump to a slide here in a little bit, you tend to see the Fed start to lower rates 4 to 6 quarters after that last rate hike. What does that mean for all of us as investors? It means that our fixed income outlook is going to probably be pretty nice over the next 12 to 24 months, because when interest rates are going down, bond prices are going up, the exact opposite of what we saw in 2022. So we think there's a good opportunity there. And since I'm on that point, I'll just stop there really quick and share this chart on the fixed income side of things to kind of back up some of my thought process there. Is what we're looking at on the fixed income side of things is you're looking at the federal funds rate going back to 1990. And I love this chart because it's very visual. You can see the Fed funds rates come down, it's gone up, it's come down, it's gone up, just like the cyclical nature of everything in markets and the economies. One thing I like pointing out though is look at how steep the heightening of interest rates were last year. It's the steepest that we've seen in a long time. And because of how steep and how quick the Fed raised rates, and this is what we were talking about before the Fed even started raising rates, it wasn't that the fact that they were going to be raising rates that was going to impact fixed income. It was at what rate they were going to raise those rates. And they ended up doing it very, very fast. Everything that Mark and other investment professionals were hoping that they didn't do. Because we know when they move that, that fast, that tends to be negative for fixed income. And that's, again, why we saw that outlook. But the thing is, what comes up must come down. And we all know that classic saying. So when you think about what is the impacts going to have on the fixed income, on markets, when interest rates start to come down. And like I mentioned earlier, looking at all these rate hiking cycles, there's at one point in time of all these rate hiking cycles, there's a day where the Fed raised rates for the last time in that rate hiking cycle. And we're pointing out those dates on here on the bottom left in 95 and 2000 and 2018. And we also show you when the federal funds rate, what rate they were at that point. So you can kind of compare to where we are today at the 500 to 525 basis points, which Again, will probably be 525 to 550 basis points, or 5.25 to 5.5% as of the end of today, depending on what Jerome Powell says. But my point being is, what comes up must come down. So when the Fed raises rates like this, we tend to see them start to lower rates over the next 4 to 6 quarters. That means, the next year to year and a half, we probably see Fed funds rate come down. What does this mean for our fixed income side of the portfolio? Is let's look at 3-month T-bills. That's kind of what your cash is paying you right now. Cash is actually paying pretty good right now. So, if you have some money in a CD or in your money market account, you're finally actually getting paid some interest to have that money there. So not a bad thing. But what does the 60/40 portfolio do over these time periods, that 1 year following the Fed raising rates? Well, you tend to see that 60/40 portfolio outperform cash almost every time, besides that 2000, around that .com bubble type sort of time cycle. Also, looking at fixed income, because interest rates are now finally paying something, you have that coupon and that interest adding to that total return picture. But you also are sort of seeing the Feds and the market starting to price in the Fed lowering rates over this 1 year period, meaning fixed income returns tend to be really good when the Fed's lowering rates. And as you can see, evident by this chart here, fixed income returns that 1 year following all of those last rate hikes, those dates, have been positive across the board. So just like I always say to everyone, this doesn't mean that fixed income is going to be positive over the board over the next year. I wish it was that. I wish history really repeated itself that often. But looking at these odds, we tend to see a very good picture for fixed income, which means those 60/40 portfolio's, no matter what equities do, we think they're going to be well supported by the fixed income nature. So again, we sort of covered a lot there, Mark. I would love you to step in and kind of maybe recap some of that, and also see if you have any comments to add as well. You're muted, quick. You're muted.
How many years have we been doing this, and I'm still doing that?
Exactly.
So it was a lot, but quick recap as far as again, in bullet points, outlook for the U.S. economy, overall good because of consumer spending. That doesn't rule out the possibility of a recession in the next, I think you said by middle to end of next year. Europe, while there's short-term concerns over just policy issues, the long-term outlook is still positive. Fixed income, I think you touched on, and inflation really. I think these two really go hand in hand because they're so interlinked because of the Fed. Right, but with inflation coming down, the Fed is unlikely to keep marching higher to borrow a term from Buzz Lightyear, to infinity and beyond, which is what Wall Street was really worried about. So there's light at the end of the tunnel, basically, at this point, as far as rate hikes, which on the fixed income side means you get paid something for holding bonds today where you haven't been. But if you could go back to that slide that talks about the 60/40, that's 60 stocks, 40 bonds portfolio, and then the various returns of the indexes, Michael. One thing I want to point out, banks are paying you money to hold money in cash. And it's nice to have like banks paying 3, 4, 5% in interest. Keep in mind, that's not locked in. It's a variable rate, right? And so if you look at the right-hand side of this graph, at muni bonds, U.S. high yield corporates, throw them out. But if you look at U.S. investment grade corporates, or even just the U.S. aggregate bond index, right? And those returns are substantially above whatever cash has been paying in most cases. I think maybe the one scenario where that wasn't the case demonstrably would have been in the great financial crisis, right? Going back to 2006, where that was the last rate hike, and then the subsequent cuts, et cetera. But by owning a bond, instead of just parking your money in cash, the total return potential is a lot higher when you're in this part of the interest rate cycle that we're at with the Fed. So anyways, I just, that I've had this not question come up, but I've had a lot of clients talking about, hey, you know what? How much money is too much money to have parked at a bank? boy, I sure do like getting paid something now, etc. And I just always try to remind them, like, hey, great, makes you sleep good at night for sure. Have enough there to make you sleep well at night, but you might miss an opportunity. And again, nobody knows the future, but if history repeats itself where the Fed stops at some point later this year, then they start looking at cutting. It could bode well for bonds total returns into the future. But other than that, I think, Michael, maybe, and I know we have some questions in Q&A. I don't want to neglect those. So if I can kind of like come to the part where we kind of address a couple of just specific items, right, that are coming up a lot in client meetings, right? So one, which is in the Q&A, is with all the noise on BRICS and the dollar potentially dropping as global currency reserve, what potential long-term market effect might that have? You want to take a stab at that one first?
Yeah, that's a great question, and I'm glad that we have a good slide on that to address that a little bit today too. And I saw that we had those questions in there, so glad I could get on this. And then I do want to address some of the cash on the sidelines thing, so I'll add a little bit to that. But let's tackle this first. When it comes to the questions around currency, this is really our thought process behind it. And what I would look at here is just the size of the U.S. economy when it comes to and the importance of the U.S. dollar for the trade and currency around the world. What makes a currency effective for global trade is the trust that individuals have with that currency, knowing that it's going to keep its value. So when you think about, Nigeria trying to trade with Brazil and Brazil trying to trade with Nigeria, Nigeria doesn't trust Brazil's currency. So they say, well, we're not going to trade in Brazil's currency. And Brazil says the same thing about Nigerian currency because they don't trust that it's going to keep its value. So what do? They decide to use a currency that's a little bit more trustworthy for the trade, which when you think of the currency share in trade, financial markets, 83.9% of all these transactions between these countries that can't trust their own currencies to trade with each other or be able to come down to one, they choose the US dollar. 83.9% of those transactions are in the US dollar. Yes, it has come down from the 87.7 it was only a couple years ago. And this is where, again, you start to get a lot of these narratives of the US dollar is losing its dominance. It's starting to lose its market share. Well, when you look pretty close, like a little bit closer, you'll notice that, yes, it's lost a little bit of a market share, but it's still by far the largest and most used currency when it comes to trade. The closest second is 6.2% of all trade, and that's the euro. So my question is, when I hear a lot of these people on CNBC and Bloomberg and these articles really just trying to get these clicks saying that the US dollar is losing its valuations and that we're not going to be the leading currency anymore, I just ask myself, what is the alternative? What is going to be the alternative to the US dollar where these other countries and can trust each other's currencies enough to want to go away and really put a detrimental impact? Now, I'm not saying 15, 20, 30 years down the road that we continue to see, this currency share go down. But right now, I don't think it's a huge concern. And I don't think, having the e-currency aspect of that and, Bitcoin, I don't think that's going to have a big impact on this as well. And then, the last thing I'll leave it at too is just when you look at that share of global reserve by currencies, again, no matter how you look at this, the US dollar just continues to dominate any way that you look at it. We actually own 58.4% of the global reserve share of global reserves by currency. Again, that closest second is around 20% or a little bit shy of 20%, and that's the euro. So again, what is the alternative? I just don't think that there is one yet. And I'm not saying that there couldn't be one down the road. I just don't think it's anytime near, maybe even in my lifetime. And I'm still pretty young, so I'm not too concerned about it. And I don't think anyone on the call really should be.
Well, those are great points. I think maybe adding on to that, and you started down the path, Michael, because our second question in the queue was the effect of the government changing over to an e-currency, my my thoughts on that is that it has to be backed by some, currency value, right? And if the U.S. converted from our, current currency to a digital currency, it'd still be dollars. I mean, your purchasing power would not be impacted really at all. It's just it's a different way to transact business. It gives the government the ability to essentially know where all those digital dollars are at any moment's time and know what they're being spent on. It's basically, I mean, I hate to say it's more control for the government over our personal finances, but when you kind of boil it down, it has the potential to be that for sure. Now, that's not trying to fearmonger or anything like that. Just, I mean, a digital currency, if you have a dollar, right, going to a digital dollar, it's still a dollar. And so that purchasing power would be minimally impacted. Do you have any, in my opinion, do you have any thoughts on that?
I would just agree with you. You know what I mean? When it comes to the digital currency, you need to have something that is going to have valuation behind that, so that it's being represented by something. And with that absence of representation, like the U.S. dollar has, I think it's tough to get a valuation that's going to take away from the U.S. dollar. And again, it's all about adoption. We need to see more people using this. And I hate to age myself, but I'm in my young 30s, and everyone expects us to just want to use cryptocurrency. I have no interest in using cryptocurrency. So you know what I mean? Like, if they don't have people in my age group wanting to switch and sell all our dollars to go to crypto, I don't see widespread adoption. And if you don't have that widespread adoption, I don't think we have to worry about it impacting the U.S. dollar as much.
All fair points. All fair points.
Mark, one thing I was going to add, kind of going back, taking one step back, you were kind of talking about this when it comes to, a lot of people want to have money parked on the sidelines a little bit.
Yep.
I've been having this same conversation with a lot of my friends and family, because we're seeing a lot of this, and it's evident by this chart here. We've seen a lot of money flow into money market funds. We've seen a lot of money flow into CDs. And just to your point, Mark, I don't think that there's anything wrong with that when it comes to, hey, this is our emergency fund money. This is the money that we want to have, ready and accessible if we need to buy something or make a large purchase within the next 2 to 3 years. But when we see a lot of individuals, and again, my uncles and aunts have been calling me about this, and I've been having the same conversation with them. And I'm saying, you're taking your long-term money that you have earmarked for retirement goals, maybe putting kids through college, maybe owning a vacation home or buying a 69 Camaro when you retire. I don't know what that goal is. I'll just be honest with you, a CD is not going to get you there. Over a long term, it's not. And when you see what we've seen kind of go into CDs, the one thing I'd like to point out is, this is a really good behavioral finance slide, I think, for the overall market out there. And I'm not saying everyone on this call has done this, but when you look at cash flow over the October 22 to June of 23 timeframe, that's sort of the lows of the market last year up until just last month. We've seen $739 billion move to money market funds. We've seen $64 billion come out of the market. And when you think about what the cash and what the markets have done over that same time frame, when everyone's going to cash, it's only returning about a 3.1% return over that time frame. And when everyone's pulling money out of their portfolios to put money into cash, the market's gone up 16.6%. So I just like to remind people that there is, again, there's a lot of uncertainty in the market, but this is a classic example of a lot of people do the wrong thing at the wrong time. And I think that's kind of what happened over the last several months. And I think there's a lot of opportunity for us to be able to have our cash working for us over the long term side of things. And the last thing I'll add on that is also, a lot of people don't take the time to take a step back and really unpeel that CD rate that they're getting from their bank or whatever it might be. The CD rate might be 5%, and that's the attractive rate that you want to get from the bank. But when you think about a client in the 24% tax bracket, what tax rate are you paying on that CD interest? You're paying 24 cents of every dollar made on that is going to the IRS. You also think about inflation being at 3% right now and the long-term target of inflation being at 2%. When you look at an after-tax basis of that 5% CD rate after inflation as well, it's closer to less than 2% that's really making you. And I just think for those clients that are trying to do long-term goals, I just don't think 2% gets you there, especially when you look at the outlook for fixed income munis, that 60-40 portfolio typically outperforming cash, even when it's paying 5 to 6% on an after-tax and post-inflation basis. So just another way to look at it. I've been having a lot of those conversations with my aunts and uncles and cousins and all that. So I'm hopefully that kind of helps someone on this call too, just to kind of look at that CD rate a little bit different, making sure that you're not putting too much of your long-term money there. So just food for thought, I guess.
Well, I think it's a great point. I don't see that we have any other questions in Q&A. I don't see anything in text chat either right now. So I might stall for just another couple minutes in case anybody has any other questions. You can load those in. But
Mark,
you know,
I'll leave it at this on this chart too. This is one of my favorite charts as we're kind of seeing if any more questions come in. You know, the women's FIFA World Cup just got started, and I think this is a good analogy to kind of leave everyone on, unless we get some more questions. But when you look at those penalty kicks, 94% of the goalies dive for the ball. Some of them go left, some of them go right. When they go left and try to do something to the left, or they try to make something happen going to the right, the odds of them catching that ball reduce greatly. And for those clients that sometimes, or those goalies that just stay in the middle and stick to the plan and try to catch that right in the middle, majority of the time they catch that ball. So I know your financial plans and what you are all doing to, you know, invest is not like playing soccer and catching balls and all that, and you know, blocking penalty kicks. But I think this also has a lot to say that, you know, sometimes we just got to stick to the plan, stay invested in that asset allocation that we probably put together, you know, that mosaic of insurance planning that we've done along with investment planning and all that. We're actually in a pretty good situation if we just kind of stick to what we're doing and, you know, don't allow the uncertainty of the markets to kind of scare us one way or the other, because that sometimes can cause you to drop the ball, I think. So I'll leave it there, see if any questions came in, and most of all, just thanks again for letting me be a part of the call.
well, always appreciate